Good evening, ladies and gentlemen, and a warm welcome to the first quarter results for FY20 press conference. We will begin the press conference with the opening remarks from our CEO and Managing Director, Mr. Salil Parekh, followed by the Q&A session. Over to you, Salil.
Thank you. Good afternoon, everyone. Really good to see all of you here and addressing everyone that's listening and watching. I just have a few remarks to start off with. Most of you here probably seen the press release. We're really delighted with the performance we've had at the start of the year, a very strong start, 12.4% growth year on year, which is fantastic for us, and we see all the traction in the market with that. Over 41% growth in digital. So again, really exciting news. For us, the large deals performance was critical, and we could see that that was at over 2.7 billion. So we see a lot of things with respect to growth well in place. Second, our operating margin comes in at 20.5, well above what the consensus was, and well on track to where we want to drive the rest of the year in terms of operational efficiencies. All of the investments are behind us, and now we see a lot of operational efficiencies starting to kick in into our operational margins and into our P&L. Next, with all of that growth, excitement, and changes, we increase our revenue guidance. So our revenue guidance in constant currency was 7.5 to 9.5%. We now change that to 8.5 to 10%. We see a really strong client connect and relevance, and with that we've changed our revenue guidance. We maintain our operating margin guidance at 21 to 23 as it was at the start of the year. We also announced a change in our capital return policy. It was up to 70% of our free cash flow we were returning in different forms, dividends and buybacks. We now have a policy where approximately 85% of our free cash flow will be returned, again in different forms, in dividends, buybacks, and or special dividends. With that, I'll pause and I'll open it up for questions. We have Praveen and Nilanjan here with me, and looking forward to your questions.
Before we open the floor for Q&A, I would request you to ask one question per publication. We'll begin with electronic media, and the first question is from CNBC.
Hi, Salil Mugdha here. Great numbers, great deal wins, digital growth is great, and of course you have raised the revenue guidance. Could you tell us where you're going to see the revenue coming mostly from, organic and inorganic, and could you tell us the contribution from the ABN AMRO deal, the Stata acquisition, especially in the BFSI vertical, and retail and life sciences seem a little soft, but when do you see the recovery here?
Okay, so many questions. I think first, we see the growth is... Sorry. So we see the growth being broad-based. So you can see in what we've shared in the fact sheet, many of our sectors are growing at double-digit. As an example, the telco sector, our Shaw business, the energy resources, utilities business. So we see that traction being quite strong. The guidance that we've given is for all of our business. We've not split that out as a guidance between organic or inorganic. We are not announcing anything new today in the inorganic in that sense. In terms of Stata, we'd already shared in the past the size of Stata, and that was already incorporated. So we're not splitting that out, but it's not a huge business relative to Infosys. But it's a very strategic business. It's a new digital platform that we're putting together with that. For the rest, what we do see is a good traction in a large deals pipeline. And we see today demand for all of our digital work, where we've shown growth at over 40%, 41.9. That's giving us some level of confidence that has given us the support to raise the guidance.
Okay. One question for Praveen and also for Nilanjan. Praveen, attrition still remains very high, 23.4 is really high. Can you give us a timeline as to when this will really come down and what you're doing on this? And I'll just ask Nilanjan also a question. The operating margin, is still a little low at 20.5. Are you still comfortable with that band of 21 to 23? And by which quarter do you see that, entering that band for the year?
Attrition is definitely higher than where we want it to be. But there is a seasonality element to this. Quarter one is historically you have higher attrition because of people going for higher education. In addition, in this quarter, we have had higher percentage of involuntary attrition as well as part of it. We are doing multiple things, and in some sense, this attrition is also a reflection of demand for talent and so on. We are doing multiple things to address this. A big part of our attrition is at the lower levels, and in the current compensation review exercise, we have tried to address it. We have launched a new employee value proposition, and we are doing many initiatives around it. So we expect over a period of time, the attrition will come down to manageable level. The high performance attrition is much lower than the overall attrition, so that's a positive thing. So we'll continue to focus on engaging with employees, giving them career opportunities, investing in their growth, and also giving a very rewarding experience and differentiating between for high performers. So we believe that some of these steps will take some time, but over a period of time it should come down. But so far we have not seen any impact of this attrition in terms of our deliverables, and we have been able to deliver. In some sense, it's also reflected in the growth that we have had.
Yeah. So I think on the margins, Q1 is always a seasonal quarter from a margin perspective for the IT industry. Two big costs which kick in across is the visa costs. So this has had an impact on us in quarter one as well for the financial year 19, the visas which come through, and also the comp hikes which we give at the beginning of the quarter. And these are adequately built into our margin forecasts of the full year of 21 to 23. And we remain confident to achieve that band.
Next question is from Bloomberg Quint.
Hi, Salil. Well, last year it was about stability and investments. This year you had suggested that it's going to be about momentum. My question then is, will investments increase, decrease, or remain the same in this particular year, and what areas will be the focus when it comes to investments? A word on, Praveen, a word on subcontractor costs and external consultants. If you can give us a rough idea about what that is as a percentage of revenues, has it increased quarter on quarter? Year on year, I'm assuming it has, but if you can give us an idea on that. And Nilanjan, given now that 85% of free cash flows will be returned to shareholders, how are you looking at the remaining 15% between capital expenditure and acquisitions for that matter?
So let me start with the question. The first year, as you shared, was about stability. We'd mentioned over time momentum and really driving some of the growth activities. We are fortunate to see the growth coming in quite strongly in Q1. And with that demand, we see the traction that I shared with you on digital and of course the increase in our guidance. In terms of investments, we are complete with all the investments that we announced as one-off. So those are over, they're done. There's no more of those investments. Our focus now is really a very clear approach on operational efficiency and a very disciplined way of managing our costs. In that, there are always ongoing investments in a business of this scale, but those are not one-off investments. What we launched last year was a little bit of a catch-up on a few areas, for example, sales, for example, digital, and so on, which we've now finished. And now our focus with this growth and the client relevance is to make sure that we have operational efficiency and cost discipline and ongoing investments which come as cost of the business.
On the subcontractor front, it's marginally increased. I think it's about 7.5% of our revenues. Overall now subcontractor is an integral part of our supply chain thing, because there are 2 or 3 reasons why we go after subcontractors. One is obviously sometimes we have shortage of niche skills, and subcontractor is a good route till we are able to ramp up. The second one is particularly on-site. Many times we don't have enough time to fulfill or deploy people from here through the visa and other things. So sometimes in the short term, you have to deploy subcontractors while we are able to backfill from sending people from here with visas. So it's a combination of things, and now it's, in the last few quarters, we have kept it in this band of 6.5 to 7.5. And we expect that to stay in that range because now it's integral part of our supply chain. And over a period of time, we will rotate some of the subcontractors out, but there'll always be new subcontractors coming in to meet the demand.
Yeah, on the free cash flow policy, firstly, it's after CapEx, so CapEx is already built in. The balance, so go to up from 70 to 85. I think that was the intent. We've been talking to a lot of the investors, the shareholders, and one of the messages was, of course, if you don't have any need for that cash, please return it. And we think we've heeded that. And I think that way it's quite progressive. The balance actually is for any tuck-in acquisitions which we may have. And I think our cash balance still is about 3.5 billion, which we think is more than sufficient for what we look forward to.
Next question from ET Now.
Hi everyone, Rahul Dayama from ET Now. I'll come to Salil first and then Praveen and Nilanjan. Salil, congratulations on an excellent set of numbers. Just want to dig deeper and understand where is this optimism really coming from? Of course, the large deal signings have been great, especially over the last 4 quarters. But Gartner has indicated that tech spends, especially globally, while there are a lot of large deal signings, the deal closures are getting delayed. Do you echo that sentiment, or that's not really the case with Infosys? Just trying to dig deeper and understand the optimism from large deal signings, really.
So if you see Q1, we've had 12.4% year-on-year growth. The way this has been composed is not through any one channel or activity. It's quite broad-based. If you look at each of our segments, most of our segments are now growing at double digit in Q1. We see a lot of traction because the digital capabilities that we have invested in are things that our clients are really focused on and are appreciating. To give you a couple of examples, in the area of insights, which is data and analytics, we see a lot of traction, a lot of movement. In the area of cloud, whether it's with partnership with the 3 large cloud providers or with some of the SaaS players, we see good traction. In the area of experience, which is all the digital design, we see very good traction. We also see rejuvenation or new demand for SAP S/4HANA and those areas. So there's a broad-based set of demand elements across our service lines. If you see, for example, our BPM business is growing very rapidly in Q1. So it's not any one place where we see it. And my sense is it's part of some of the investments that we've put in place, and especially in digital, but also in automation, which is helping us across the board. But hopefully, this is something that we can sustain and drive through with the focus we have on digital.
So you're saying you can sustain this going ahead as well?
That's the reason we've increased our guidance.
All right. Praveen, 2 set of questions. One, BFSI, last time also you had indicated that for full year, you're still strong. I want to understand, is this limited to some client-specific issue, Europe, or this is sort of broadening out to the US market as well, the pain points really as far as BFSI? And secondly, also the talent strategy for the US market. It's interesting that Infosys has applied for a higher number of H-1B visas. Even as you go around with investments in localization, how will that really pan out going ahead?
See, on the BFSI segment, we had a good quarter. We had a double-digit year-on-year growth on constant currency, partly aided by the Stater acquisition. Overall, as I said in the past as well, we are reasonably optimistic about our prospects in this space. In the large deal wins that we have had, about 3 of the large deal wins this quarter has been from the BFSI segment. In the past as well, we have had a good percentage of large deal wins from BFSI. While we see softness in the capital markets in both US and Europe, but on the other hand, we are seeing a lot of opportunities in cards and payments or in retail banking, corporate banking, and so on, driven by investments in digital transformation and legacy modernization. So we feel reasonably confident. Obviously, there is softness in some part of the BFSI space, but there is also growth opportunities elsewhere. We have done well this quarter, and we are hopeful in future.
on the US talent?
Yeah, on the US talent, one of the statistics is about 2 years back, we had committed to recruit 10,000 people. We have just completed that. We have crossed the 10,000. We have met the commitment. A big part of it, a good percentage of it comes from even hiring from universities. About 2,500 plus people are from the universities. So that US recruiting in US will still continue. We'll continue to recruit because there's tremendous demand for talent there. At the same time, we just talked about increase in subcon and so on, right? There's always demand for talent. So we also need to create opportunities from a supply chain perspective of having the ability to send people from here as well. So that's one of the reasons we have applied for higher number of visas, so that in the long run, we will be able to meet our talent requirements in a much more agile manner and reduce the dependence on subcontractors.
All right. Nilanjan, just, sorry, margins again, and I'm sure everyone would sort of pitch in and want to understand. Last time, interesting, I think Salil mentioned there's no structural issue with the margin structure. IT business continues to be a high margin game. Do you still echo that sentiment? Also, as far as localization efforts are concerned, a large part of it has happened. So what are the levers do you have in the coming quarters really, apart from operational efficiency, automation also that you're, what else do you have to sort of ensure that margins can, while of course analysts were penciling in an impact wage hike, when would it get better?
Yeah, so if you see the RPP as well this quarter, it has gone up versus the previous quarter. So how much we realize per person, the FT also, you can see that. From elements of perspective, how do we influence the margins going forward? Of course, automation is in the core of what we do, and we do it for ourselves, we do it for our clients, and we continue to see productivity improvements in that. The bigger next cost, of course, are on-site employment costs. And again, looking at the on-site offshore mix, that's something we continuously optimize in projects, and also creating on-site pyramid. And a big part of that, as Praveen mentioned, is the whole hub structure and the localization. So we were able to take many more freshers into our system and create a much more cost-efficient pyramid model, and we think that's quite unique for us. All of this, as we know, will play out as the year progresses. We've had these first quarter impacts, which are, as I said, seasonal from the industry. But if you look forward into a guidance of 21 to 23, and we're sitting already at 20.5, of course, our margins will have to go up as the year progresses, and we're quite confident of that.
Next question from Deccan Herald.
Hi, how are you? So basically, a couple of questions here. The first is on buybacks. We have seen the government proposing 20% taxation on this thing. Now, Infosys has been frequently doing buybacks, couple of them in past 2-3 years. So how do you strategize now that investors' wealth would get impacted because of that taxation, 20% taxation? How do you strategize on that front? And second question, if I can see, you have stopped reporting hiring numbers from this quarter. So, and there is no explanation, which ideally should have been there. There is no explanation whatsoever in the fact sheet that you have provided. Can we know more about it? Why have you stopped the reporting on hiring numbers?
So I think we give the net adds and the attrition figures in any case. So it's quite easy to derive. We just thought didn't make sense to add the gross adds, because from the net add and the attrition figure, it's quite easy to get the gross adds in. we just remove some of the redundant information. Okay, all right, we'll take that into consideration, definitely. I think on the buyback, I think we've seen, all of us have seen it. I think it's just too premature to say where we're going to end up, but we are going to continue our existing buyback as planned by the board. We've already finished about 6,000 odd crores of buyback till the end of June, and we have about 2,200 odd crores left, and the board has approved the continuation of buyback during this quarter.
Next question from Money Control.
Hi, I'm Swati. So there have been a little concern about the hikes for the senior level job band. So I have come to know that a couple of them haven't even got the hike email, which they get in April and which is payable sometime in July.
Yeah, see, hikes, we have always staggered the hikes when people get hikes. At a lower level, people typically get hikes starting April. At middle level, they get starting July. And for senior management is starting October. So that's something we have had in the recent years. So there is no change in that approach. This time at a lower level for some small percentage of population, we moved it from April to July. I mean, these are things we keep on verifying at period of times. But other than that, there has been no change in any strategy or anything. And I mean, it's what we said in April. It's something similar.
And again, regarding the attrition, it's 23.4% is quite high. And you did mention that you're doing a lot of efforts. But could you please know, when do you see that reducing? We have been seeing that increasing over the quarters consistently, 23% and 20%, now it's 23.4%. Could you give a timeline on that?
I mean, it's difficult to, we have to really persevere on that. As I said earlier, it's something which we don't want. I mean, it's higher than where we want it to be. At the same time, it has not really impacted our day-to-day business. There are a lot of efforts, including addressing whatever the pockets of areas where we have had challenges through the current comp review. We have tried to address it. We have tried to enrich the experience for people. A lot of efforts in terms of engaging with them better. A lot of things around interesting work, a lot of investments in their career opportunities, a lot of opportunities for cross-movement, rotation, and so on. There's a continuous dialogue. We take feedback and we continue to work on it. This is something we have to continue to do that. Difficult to predict when it will come down, but we will continue our efforts on that.
And also, could you give an idea on how many joining letters were sent this year on quarter basis, the number of people who've been inducted?
We see overall for this quarter, we have recruited close to 8,000 people. Freshers about 2,500 or something, and for the year we are looking at about 18,000 people or so from the university's perspective.
It's a little higher than the figure you had given last time, or?
I don't remember what I gave, but this is something we keep on calibrating, right? Because based on the business and the outcome, we keep on calibrating.
Next question from Business Today.
Hi, Rukmini. Going back to the capital allocation policy, you've been a company with ethos of conserving capital. Now, you know, your promoters have been talking about capital conservation all along. 85% of your free cash flow you're willing to give back to your shareholders. How much of, a leeway do you have if you're looking at a bigger acquisition? Or is this an indication of you not looking at any kind of bigger acquisitions, or, your bandwidth to go out and chase the market? And the other thing, Praveen, just a little more clarity on the hiring numbers as such. Your peer has gone ahead and hired big time, the biggest in the last 5 years. And they're saying that they're looking at the kind of growth and really bulking up their talent to be able to reach out to the market when need be. If you're seeing growth and you're anticipating demand, etc., your readiness in terms of your own the talent supply that you have, how is that being managed? If 18,000 is what you look to roll out, but at the end of the day, how many people join is again a bit of a question, right? Thanks.
Yeah. On the capital allocation, I think at first, this is a free cash flow positive business. So except for any M&A, you really don't need the cash. And the shareholders have been telling us loud and clear, is if you rather give me the cash back than put it in the bank and get me 6%. And that was the whole ethos, is that if the value creation in their hands is going to be more, we should return the cash back. Now, having said that, we've kept the 15%, like I mentioned earlier, for any tuck-in acquisitions. Our balance sheet is still very, very strong. It's very, very healthy. We are still at 3.5 billion. So we can, at any point of time, dig into these reserves whenever we want. And at this moment, we felt it was quite okay to give 85% back and be quite confident around it.
And your capital allocation, the policy as such, so is it a lot more fluid than what it used to be? You're looking at it on a going basis?
Yeah, we want to have within that, a progressive dividend policy. We want to have also room for giving special dividends, as you see in the policy, the way it's announced. And that's the way also our investors have been telling us, is to have a more stable, consistent, growth-oriented dividend policy. And that will also give us more headroom over the years to return this cash back.
Yeah, on the hiring front, the numbers I gave is numbers we are recruiting from the campuses. We also hired laterals during the year. And I mean, we know what the demand, we know the anticipated attrition, and and today the utilization is around 83 and odd %. In the past, we have operated at utilization of 84, 85%. I think we have enough leeway in the system in our operating model to deal with whatever demand that comes. So it's less of an issue. I think we are comfortable.
Maybe I'll just add to it. I think if you step back, the big picture for us is we have 12.4% growth in Q1. So we are not talking about the fact that we will recruit some people for some demand that will show up in the future. This is the demand today that we are driving the growth. We have 2.7 billion in large deals we have won today. So we're not talking about a concept of recruiting some people for a future work. Our growth is evident in our numbers today. And that's what really is critical. And that's how we look at the business going forward, as opposed to proxy measures, which are other measures for going forward. In terms of M&A or capital return, we want to be very clear that the 85% return is a discipline to return cash back, because we have investors who want to see this discipline, and we as a management team and a company want to be disciplined about it. Having said that, we still have 15% to buy things. We have $3.5 billion on our balance sheet if you want to buy something. We have one of the best balance sheets there is in anywhere, certainly this country or outside. So we can raise any amount of debt that we want to if you want to buy something. So there's no constraint that this puts on us from an M&A perspective. All it's doing is putting a discipline that we're going to return this money because that's the right way we think the business should be run.
Next question from Reuters.
Hi, I'm Arnab from Reuters. So you've increased your revenue growth guidance, but the macro challenges still exist, right? So I just wanted to understand, in the US and in Europe, what sort of challenges are you expecting, and which verticals do you think will be under pressure?
On the macro, I think if you see, the global economy today, at least the US Q2, their Q1, so our Q4, Q1 here, they've had good growth in the macro in the economy. Our growth today, if you look at decomposing the business, is coming a lot from the investments we've put into and the scale we are building in digital. That demand we see, I'm not saying it's good forever, but from what we see today, we can see that this is supportive of the guidance we've given. This is not to ignore that the macro is somehow going to be rosy all the time. But within what we see today in terms of the client connects we have, the business we've generated, and the demand that we see in these new areas, that's where we've given the guidance. And the guidance is between 8.5 and 10. So we've narrowed the band and increased a little bit the bottom and the top end of the band. So it's a way to indicate that we see some confidence in what we see in our business in these areas. There are some concerns, as Praveen will share, in some of the segments. For example, in the last quarter, we talked about some pockets of manufacturing in Europe. We talked about life sciences. Those are things that are not going away in that sense. But we still see good growth. One of our segments growing 20% year on year. Another one at 17% year on year. So that allows us to build a little bit of confidence because we have a really diversified business within Infosys.
Next question from Hindu Business Line.
Hi, this is Vivek Anand. So I was just listening to your answers about the capital allocation policy. So if you're saying that after increasing the payout to your investors based on your free cash flow, based on your growth and your margin guidance, you are expecting at the same level to be able to pay your investors. That means your growth, you've already baked in the future for the next 5 years, because you obviously cannot change it again. Very soon, I mean.
We have said that approximately 85% of our free cash flow, whatever that is, each year in a cumulative 5-year span, we will return. Cumulative because with different laws, rules, and regulations, we cannot make commitments on any one pattern of return. We have a commitment on dividend in the nature of it, and that we will be consistent with it. But because there are other components, buybacks and special dividends, we cannot make a commitment per year given the laws and regulations. But it doesn't imply anything else beyond that. It's simply saying 85% of free cash flow.
Just one more question. Can you just give an update about the retail sector? One of your competitors had mentioned that there is some growth issues, like some stores are shutting, like Sears is shutting stores all over the world. So that has impacted their business. Are you seeing any impacts of the retail sector, the brick and mortar stores reducing their stores? Does that impact you in any way?
See, retail sector normally will be fairly volatile because they're tightly linked to the consumer sentiments and the macro. So you will see some volatility on a quarter-on-quarter basis. For us, last year, first half, we had fantastic growth in retail and it slowed down in the second half. But this quarter, we have slowly started seeing some uptick in retail. So we do find a lot of retailers continue to invest because there's a tremendous urgency to compete with the likes of Amazon, Facebook, Google, and so on. So there's a continued investment opportunities within retail on the digital transformation, a lot of investments in terms of multi-channel store experience and so on. So we have seen, as compared to last quarter, we have seen some uptick in retail this quarter. But again, we have always consistently said that's one sector which probably you will see some degree of volatility depending on the macro and the consumer sentiment.
Next question from Times of India.
Hi. Sir, your digital revenues has crossed $1 billion. Can you break it down for us? And secondly, as much as there's so much momentum in the digital segment, the revenue per employee doesn't really reflect that. In fact, it's been flat and it's come down from 2017-18. So revenue per employee, is that a good measure of even considering your digital momentum that you are seeing in the market? And secondly, we hear there are some redundancies already in job level 7 and above. So is it an annual exercise, which is the bottom trimming of 5%, 5 to 10%? If you can give us a clarity on that.
On the digital, we don't break down the digital beyond what we've shared in the information. So as you know, we have internally at least 5 areas that we are very concentrated on, and we see good traction in those, but we don't break it down in terms of disclosure in the market. In terms of revenue per employee, I think the way we look at it internally is there are 2 distinct types of businesses. The digital, where we've shared in the past that we see a better margin profile compared to the overall company, and that's what we continue to see. So now with 36% of our business in that space and the growth that we see, we can now see clearly a situation where we will flip the business in the near future, and that will give us more and more traction. So the revenue per employee, unfortunately, as a combination of everything today, and we look at it internally a little bit differently. In terms of redundancies, we have no comments. We have an ongoing approach to our business and how we look at operational efficiencies, and that's what we talk about.
Also, you have about 10,000 people in the US. So if you can talk about the utilization there, is it optimally utilized or it's a partial utilization in comparison with your deal pipeline? If you can just take us through that.
So we don't break up the utilization we share externally into different geographies. We feel we have a lot of operational levers at our disposal to help us to improve our operational business metrics. One of them is the utilization. My own sense is most of our levers we can do better with, but those are not statistics we normally share.
Next question is from The Hindu.
Hi, Minnie here. Most of the questions around attrition is already taken, but still I have few more to ask. Praveen just spoke about this manageable level of attrition. Can you tell what exactly that level going to be? And also recently the US actually lifted this cap on this country cap on the green card. So will that be going to be any good for you? And also, how many visas have you applied for so far this year? These are the things.
See, I'll start talking the last one on the green card. I mean, there is a new this one. So every year we do apply for a percentage of green card, and we don't see any change in that approach based on the new thing. It's only that some of the processing of green card will be much faster, and there may be more number of people eligible. So that's on the green card. What was the first question? Okay. Yeah, we don't really talk about number of visas we have filed, so we don't do that. And what was the first question?
The attrition.
Manageable, okay. See, historically, when the business was relatively stable, we used to have attrition between 13 to 15%. But today it's not, I mean, today we see a lot of disruptions happening, a lot of shortage of talent, a lot of new technologies coming into place, a lot of demand for skills. So this is a cycle where the industry itself is going through disruptions. So it's very difficult to comment what is manageable or not, but our approach is to make sure that we are able to retain the best talent internally so that we have less dependencies on subcontractors, or we will reduce the effort in terms of hiring if we are able to retain more. So in a normal circumstance, 13 to 15 is what we have seen in the past. But today's environment, I would not call it normal because we still see a lot of shortage of talent and a lot of adoption of newer technologies, but there's a huge talent gap. We will continue to see some higher degree of attrition.
Next question from Business Standard.
Hi. Good afternoon, sir. Devasis from Business Standard. I do have 2-3 questions. On backup envelope, when I do calculate the P&L of on the reported currency side, it seems that the incremental revenue actually which Infosys is earning is coming at a greater cost, as a higher cost. You have, beforehand also has said that the company is not entering into a structural thing where your margins are declining, but it's not reflected in numbers. I just need a view on that. Secondly, you have taken a lot of initiative in signing up JVs, and the bigger deal momentum, large deal momentum was also pretty good. In the Q1, how much of revenue actually is coming from those kind of initiatives, and how much of the deal which you have signed, I think 2 billion worth in the Q4 of last fiscal, how much have it has actually ramped in and reflected in revenue in this quarter? And thirdly, don't you think when you increased your revenue guidance to double digit, when you see the core revenue actually is flat and the reported currency side is actually negative, what drives that optimism that you'll be able to achieve a double digit revenue growth number when 70% of your revenue digital and the core thing is actually declining or flat? Thanks.
I'll start with the last one. I think we've increased the guidance to 8.5 to 10. So that's a range of guidance. It's not that our guidance is only 10. So it's not a double-digit guidance, to be very clear. But it is part of the guidance, and that's what we're driving to. What we see is a lot of growth that we start to see in digital. To answer part of your other question, we don't disclose the amount of revenue from Q4 large deals, but that is already starting to flow in. The JVs that you mentioned were strategic JVs, the two which were extremely strategic with Japan and Temasek. Those are small, as we had shared at that stage, those are small starting JVs where we have a long view of this in the medium term. But they're already contributing revenue for us in Q1. But those are not the big ones. The big contribution obviously is from the deals we have signed. I think the first question was the structural margin question, maybe.
Yeah, so I think a few of you had already asked this question. I think last year to this year, as you've seen, we have made those strategic investments, which we called out when we rolled out the navigating your next strategy about digitization and localization and the sales investments. I think, like we said, that's behind us last year. And as we look forward to this year, our guidance, which is 21 to 23, actually reflects a stabilization of our margin profile. We are at 20.5, and that was largely because of the one-offs, which is factored into the guidance of 21 to 23. So like I said, going forward, we expect this margin profile to improve as the year progresses.
Next question is from Financial Express.
Hi, I'm Srinath. I want to know what are the business segments having demands for cognitive technologies and enterprise cloud technologies, the ones you have mentioned here? And also, are you increasing your number of product packages or service packages in the modern technology side? And how are you managing talent for that across geographies?
So the cloud, I think enterprise cloud, we see that demand in every segment. So even in segments where we've indicated overall weakness, say life sciences, we see really good traction for the cloud space. And there are two types of demand. One is the enterprise cloud players, which we are partnering with, whether it's AWS, Azure, or Google Cloud. And we see demand in each of those three. The other is SaaS companies, as an example, Salesforce.com or ServiceNow. And we see demand in those areas as well. So, and it's across all segments, in some more, some less, but it's really broad-based, that demand. In terms of talent and how we look at it, you know, we are in the process today of really making all of our company into an agile development shop. All of our offices, locations are being refitted. For example, 2 weeks ago, we launched a new digital design studio in the UK. We have a very exciting digital design lab here in Bangalore. And it looks like a very different type of environment. And this is one of the ways building those capabilities, building those environments that enables talent in that space to work, succeed, and thrive. So those are the approaches we are taking to those areas. So there's a lot of focus on both on reskilling and also on making sure that we bring in talent from colleges straight off, freshers, to make sure we train them from the start. So the reskilling program is something we put in place with our own platform, Lex, where we have now almost all of our employees having access and downloaded it, a lot of them using it, almost 35 hours, 35 minutes a day that is being used to drive all of this activity in the reskilling. So we have a lot of that traction in the reskilling here itself. And then we also bring in talent which is from adjacent spaces, and we do refactoring of that talent or skilling them in these new areas. And those are the techniques that we're using. Having said that, it's a constrained environment because there is not enough supply. And so that's something we have to work at every day.
Next question from Economic Times.
Hi. Congratulations, Salil, on good numbers. Just a couple of questions. Now that you've completed 10,000 hiring in the US, do you have another target for the region? And I think Infosys has been talking about non-STEM hiring as well. You know, so if you can give us by now, what's the percentage of non-STEM employees who are into design thinking and all other areas like liberal arts students and all that? If you can give that percentage. And one final question on Japan. I think you completed that joint venture with Hitachi. And I think Japan government is coming up with a guideline from August 1st saying foreign companies cannot have majority holding in high-tech areas, and you're going to have 81% holding there. So any thoughts on that?
So on the US numbers, we have no new numbers to announce today. We are really delighted that the 10,000 is complete. We have an internal target for sure, and we are progressing very rapidly. But at the right moment, we'll share that in terms of announcements. In terms of non-STEM, there's a huge program both in the US, in Europe, and in India. US for community colleges, for design skills. We have the partnership with the Rhode Island School of Design, but with many other community colleges across different states, and that's going on. But again, we've not shared any stats on the percentage that is being recruited. But we're already doing that in the US. We're also doing some of that in India, where we're doing not so much non-STEM, but 3-year programs versus 4-year programs within the talent base. In terms of Japan, we look at what this regulation you mentioned is. I'm not aware of it, and see how that impacts us.
Next question is from Cogenesis.
Hi. So your deal wins during the quarter have been significantly higher than expectations. I want to understand, is there any bunching up of deals that has happened? And how do you see this sustaining going ahead? And secondly, any impact from the restructuring at Deutsche Bank?
I think the restructuring in Deutsche Bank, I read in the papers today, is impacting some people.
So what is the impact for Infosys, sir?
Well, as I said, I read somewhere that it is impacting some people, but we have no impact that we want to discuss. On bunching up of deals, large deals are always bunched up. They're volatile, meaning the volume that you get. We've been fortunate to get very good large deals wins. If you look at Q4, I think Q3 was very strong, Q1 is very strong. So one of these quarters, there will be some volatility. We don't have a forecast on when it will be, but these things are not something which happen consistently over time.
Thank you, everyone. With this, we come to an end of this press conference. Friends from media who would like to listen to the earnings call, please move to the media center in building 12. We've arranged the carts outside this building to drop you to the media center. I would request you all to join us for refreshments at the MC Lounge. Thank you so much. Have a nice evening ahead.